Welcome back to Profiteers versus the People, everybody. The podcast where we debunk the famously self-made wealthy people. Join us for another side episode, which is this episode. In the year 2000, Dale Deere was rear-ended by Jason Aldridge, a road-tripping college student, and was badly hurt. Aldridge's policy was with Allstate, a spin-off company of Sears, which was well regarded up to this point. Deere submitted a claim to Allstate for $24,000, and although it was well beneath the $100,000 threshold provided by Allstate, the claim was denied. The caseworker later said she just took a pass. Aldridge got word of this while returning to his dorm. While coming in, he was greeted by a police officer who handed him a court summons. He was being sued by Deere for $2 million. Though the insurance company's reasoning for this denial is never thoroughly explained, when Aldridge sued Allstate for this bullshit, his lawyers stumbled upon an answer to why the insurance industry, once heralded as a safety net for the middle class, is now such a disgrace. As it turns out, what kept Jason and Dale from the money promised by Jason's policy was a combination of Mckinsey expertise and evil robots. Though Jason's attorneys were onto something big, this bombshell wasn't going to reach the light of day without a massive fight from Allstate. Allstate refused the attorney's request for the slides and then refused a subpoena by the judge for those very same documents, at which point they were held in contempt of court and began incurring a $25,000 daily charge until the documents were produced. This is what this episode is going to be on: insurance and what's happened to it in the last few decades. So yeah, I'm Rad Bill. Money Mike is tired. We've been working hard lately, so he's taking a little vacation. Send him your well wishes. Tell him you miss him. The rest.
This is Profiteers versus the People.
To kick things off, join me as we travel back in time for a glance at the birth of insurance. The year is 1902, and the Order of Preachers, which I guess was a pretty influential institution back in the day, unearthed the Code of Hammurabi, which demonstrates the very first traces of insurance as a practice thousands of years ago. We're not going to talk about any of that here, though, because really it's irrelevant to this story and in general just excruciatingly boring to research. Instead, let's work backwards. Why do so many people, myself included, hate an institution that our fragile lives so often depend on? Is the insurance industry entirely to blame for the problems it's causing us today? Well, bare your teeth for a second as we acknowledge external circumstances for the position of the industry and give penance to the other bad actors in the room. Chapter 1. Gotta have home and auto. Okay, so you don't have to have it, but you have to have it if you don't have enough cash on hand to cut a check to rebuild your life, for which you would otherwise need home insurance. Or, for the life of another, you would need car insurance. We're not going to touch on life insurance in this one, or more professionally oriented products like errors and omission insurance. In the case of car insurance, even if it's being required by law was the result of industry lobbyists, I don't consider that a bad thing. Before you jump in to cut me off, I know this doesn't mean it's required by law in every single case. In fact, formally, it's not required by law to maintain car insurance so long as you don't drive a car. However, this is America. Substantively, you need a car to survive in all but 9 American cities, so we're calling it a must-have. The reason car insurance is required by law if you own a car is because so much of what we do in a car is at the risk of those around us. The unpermitted work a car can do to another car, public or private property, or the human face is often prohibitively expensive to reverse. For this reason, it makes sense that if you drive a car, you do what's necessary to protect those around you from your own deplorable driving. Rad Bill. Sure, you drive like an old man, but people get hurt all the time by elderly drivers. So if you're going to drive a car, you have to back it up with commitment to the well-being of everyone else. Home insurance, by comparison, is really only there to protect you. and your bank, which will require it if you have a mortgage. Once again, it's for the benefit of others, and though I'm going to be far less sympathetic to the well-being of an American bank, its requirement is justified pretty practically. A bank is giving you a shitload of money to buy an embarrassingly small house and doesn't want to see all 900 square feet of their investment go up in flames again. Fine. Rat Bill, you need these policies because you drive like a dead guy and you won't stop smoking in bed. For protection against the ramifications of these decisions, the substantive law of the land is on your side, and a few $100s a month is money well spent. But what about several $100s a month? For car and home insurance, this is becoming an issue. If you're fortunate enough to own a home in California, you know how shaky things can get and that the odds of it catching on fire are higher and climbing, regardless of your evening routine. If you own a home in New York City, floods are a rising concern. And if you own a home in the Bible Belt, you know that the chief concerns are acts of God. Hurricanes, tornadoes, blizzards, flash floods, hailstorms, rain, wind, the rest of it. The rising frequency of these crises mean that insurance companies have to raise premiums in their respective regions most affected. As a result of this, despite the cinematic value of California's weather issues, the Bible Belt is seeing the greatest premium spikes, and Florida is leading the charge. Home insurance premiums in the Sunshine State are quickly approaching $11,000 per year. The runner-ups were Louisiana, where the average was $6,354, Oklahoma at $5,444, Texas, Mississippi, and Colorado at $4,000, and Nebraska, Alabama, Kansas, and Arkansas in the mid to high 3,000s. Rising premiums for reinsurance, which is basically a crisis insurance for home insurance companies, is also fanning the flames here, which is hilariously ironic and itself a rabbit hole that I'm going to avoid going down here. I hate doing this, but insurance companies, to some degree, are victims of the everything problem too, and what they're doing is passing the cost of climate change and greedflation onto the consumer. A tragically predictable outcome, but not one that we can reasonably blame exclusively on insurance companies. That being said, the blame for a much more existential and long-running trend can be placed squarely on the shoulders of insurance companies, and that is the very thing that our friends Dale Deer and Jason Aldridge were grappling with at the start of our episode. Chapter 2. Home and auto insurance suck now. By the middle of 2008, Allstate was grappling with a growing legal dogpile. In 2007, the Missouri Supreme Court jumped on board, levering its own daily fine and demanding the release of a slide deck prepared for the company by Mckinsey Co. in 1995 as they were finalizing a spinoff from Sears. This was the bombshell. David Berardinelli, a New Mexico attorney suing Allstate on behalf of an elderly couple who were badly injured by a drunk driver, was the first to clap eyes on the slides. Predictably, Allstate refused and fought the release of the slides even to just Berardinelli under the pretense that they held trade secrets. Eventually, though, they complied and released the slides to Berardinelli with a watermark that prevented them from being scanned or photocopied legibly. Berardinelli dug in and was very apparently appalled by what he saw. He asked the judge presiding over his case to grant permission for public release of the slides, and the judge complied, once again at the rabid objection of Allstate. Berardinelli returned the watermarked slides to Allstate under the assumption they would furnish an unwatermarked slide deck, but they unsurprisingly refused. Back into the archives the slides go. Little did they know, however, that Berardinelli had sprung a trap of his own. While studying the slides, Berardinelli had recorded his thoughts and legal interpretation of the slides using a method where one presses an ink-filled receptacle against a piece of wood pulp, which is about as thick as the edge of a dull knife. During his review, he had filled 300 of what are called pages with these handwritten notes, and although Allstate would fight their release in court as well, Berardinelli got approval and released these notes far and wide, bringing a firestorm to Allstate's front door. Prosecuting attorneys around the country salivated as these pages were released, and in no time, the Florida Insurance Commissioner caught wind of the scandal and launched their own investigation. When Allstate refused their order to release the slides, the insurance commissioner played a winning move. From the start of Aldridge's case to this day that we're referencing right here, about 2008, Allstate had racked up $7 million in fines for contempt of court charges, which on its own was unheard of at this time, in case you're wondering. But if they still wished to keep these slides confidential going forward, they would have to halt all business in Florida, the third largest car insurance market in the country. At last, Allstate relented and posted the slide deck on their website. As it turned out, their resistance to the release of these slides was a justifiable decision. The plan the slides dictated had been put into effect 10 years prior to the ultimate release of said slides, and after seeing Allstate's runaway profits and the company's quadrupling stock price, other insurance companies like State Farm, the largest property and casualty insurer, AAA, and Liberty Mutual soon hired Mckinsey to help them launch the very same program. Allstate was, in effect, protecting the entire industry from a reckoning. Under the ownership of Sears, the company had paid out the majority of income from premium payments in claims since its founding in the 1950s. Insurance adjusters, bound by a coveted duty to look after claimants, would frequently pop out, meaning they would visit claimants at their homes to deliver claims checks. A nice personal touch. For this work, Allstate spent decades generating a modest profit, but in preparation for their spin-off, company executives wanted to shift gears a little. In 1994, the top 5 executives at the company collectively took home $2.95 million. This, they thought, was going to have to change. And what better company to help them bring about that change than Mckinsey? The quickest way to improve profit is always cutting cost, and although the company found plenty to cut by tackling the claim filing process, by reducing overtime, reducing the cost of printer paper, and cutting down on expenses from mail, the operating costs of the company represented about 17% of their expenses. The real fat of the operation was concentrated in what the company was spending on premium payouts. For this, McKinsey proposed in their slides that the company implement McKinsey's Claims Core Processing System redesign. The overarching theme was this: rather than taking time to digest a claim, Allstate should shift their focus to profit by hastening turnaround. Rather than calculating a fair cost, they could then come back quickly with a lowball offer and pressure claimants and policyholders to take the deal. One former Allstate adjuster, Shannon Brady Kamatz, whose father worked at the company, described what the adjuster role had become under these new objectives when she later became an expert witness. As an adjuster in the new Allstate, you're crammed into a room with 10 other adjusters, each of whom is incentivized with job security and bonuses to persuade callers to accept the lowest possible payout. Brady's was the unrepresented unit. As that title would indicate, they were responsible for negotiating with those who didn't have any legal representation. A big part of their job in that unit was to keep it that way. McKinsey correctly assumed that plenty claimants would explore the premise of hiring a lawyer while on the line with Brady's department. When this happened, Brady and other members of her team would respond with any of a great variety of misleading or outright false objections to the idea, all distributed to the team within the pages of McKinsey's Attorney Economics. Counterpoints to the idea included: the lawyer's going to take 25 to 40% of the settlement. Don't you want as much as possible? This line of dialogue omits the fact that those who hire attorneys typically take home 2 to 3 times what those without an attorney take home. Hire a lawyer, people. Under the new program, adjusters' performance was tracked in metrics and publicized for the whole team's viewing pleasure. Because they were the easiest marks, adjusters were incentivized to target the poor, the uneducated, the non-English speakers, and the elderly on Social Security for the lowest payouts. They were typically most desperate, you see, and thus most sensitive to a slow turnaround. In many cases, the company would just mail the claimants a lowball check, and cashing it was tantamount to acceptance. One slide in the deck read as follows: The way we approach claimants and develop relationships will significantly alter representation rates and contribute to lower severities. A lawyer who worked with Allstate from 1992 to 2003 explained how Mckinsey broke this slide down for the team. Allstate was paying too much for claims, which had created a corporate culture of claimants expecting to be paid for claims. Mckinsey posed that this was bad. To this end, Brady's team was strongly encouraged to close almost all cases in 30 days, often offering a lowball payout before the case was even evaluated. Stragglers were expected to be paid out before the 60-day mark, and any holdouts past the 90-day mark were either transferred to the fraud division or the represented unit, which was unsurprisingly tasked with handling those that had decided wisely to hire legal representation. Mckinsey figured that about 10% of claimants would refuse a lowball offer or hire representation. For those who refused to claim, the goal would be drawing out the process and making an example of them. For those who chose to hire a lawyer, the goal for Allstate became delay, deny, defend. Beat down the claimant in court, draw out the process, and run up the cost so that word spreads among claimants' attorneys that the cost of litigation against Allstate can't justify the anticipated payout. A slide covering represented claimants in the Mckinsey deck showed a picture of an alligator to indicate that Allstate's strategy here should mirror an alligator's strategy with its dinner. Sit and wait for the opponent to give up. The agency would spend years in court fighting if necessary to meet this end. Another slide referencing the reduction of the payout amount read, "Winning will be a zero-sum game." Winning will be a zero-sum game. In 2007, Bloomberg posted an expose on how insurers were using the Mckinsey method to lowball customers on homeowner claims. That same year, J. Robert Hunter, an insurance expert with the Consumer Federation of America, cited McKinsey's specifically as being responsible for record low premium payouts and suggested that their being used by so many insurance providers equated to collusion. According to Allstate, however, there is one part of their operation that McKinsey hasn't had as much to do with. Chapter 3. Acknowledging the evil robot in the room. McKinsey remains silent on this point, as always, but Allstate insists that McKinsey didn't have anything to do with the implementation of Colossus, Allstate's ridiculously named claims estimating computer, or the implementation of its sister product for their property insurance arm, Xactimate. Though Allstate has expressed repeatedly that Colossus was put in place to cut down on turnaround, most insiders allege that its main purpose today is to lowball payout amounts prior to the further lowballing done by the adjusters, who at this point read anything not printed by Colossus off of a script, effectively just working in a call center. A man responsible for tweaking Colossus to favor the insurer, Mark Romano, once an insurance adjuster himself, remembering the old tenets of the job fondly, claimed he could basically turn a knob on Colossus to determine the value of specific cases. He would be deployed to, quote-unquote, turn a knob whenever payment data indicated unfavorable results, and on one trip found that adjusters were submitting an outsized number of herniated disc claims, which yield a much higher payout than soft tissue injuries like whiplash. That was a direct quote from the book because I don't know a lot about herniated discs, and I don't know a lot about whiplash. For this occasion, he was told that instead of calibrating the machine, he needed to calibrate claims teams across the country. Disregard neurologists, radiologists, orthopedic surgeons, or whoever, and reduce the number of herniated disc claims, damn it. This directive broke the man. Accustomed only to calibrating robots with their knobs, he soon came down with debilitating headaches and ultimately took disability. He was encouraged to take early retirement, and when he did, the headaches subsided and he joined the Consumer Federation of America, where he's since worked to spread awareness of these practices. The presence of a knob, as it turns out, is pretty common for insurance robots across the board. Evacor is the health insurance industry's evil robot company, and though their program can't lowball offers, it too has a dial that determines what percentage of payout requests are submitted for review, which most often leads to denial. Evicor is owned by Cigna, and though they contract with over 100 insurance companies nationwide, including United Health, Aetna, Blue Cross Blue Shield, and some medical and Medicaid contractors, they are not without competition. Another big player is Carelon Medical Benefits Management, which is owned by Elevance Health, once Anthem. Companies like these issue guidance on imaging, oncology, cardiology, gastroenterology, sleep problems, and the like. Complicated stuff that insurance companies typically lack the expertise to examine or interest in hiring someone who does have that sort of expertise. When asked, a spokesperson for Evicor explained, "We were improving the quality of healthcare, and by very happy coincidence, we're also decreasing a significant amount of unnecessary cost." The seemingly ancillary decrease in cost, to the surprise of literally no one, is at the center of Evicor's pitch to insurance companies. The organization promises insurance companies a 3-to-1 return on investment, and salespeople for the company boast a 15% increase in denials. In Arkansas, where publication of denial rates is required, Evicor denied 20% of claims. For comparison, the Medicare equivalent in the state denied just 7% that same year, 2022. Though Evicor claims that doctors can resubmit claims for approval with Evicor, if the company says no on the first go-round, they're usually just going to say no all over again, and most of these companies have weaponized their appeal process to wear the user down. There's an excellent Philosophy Tube video on this that I'll link in the sources that talks more about this. Check it out. Abigail, please notice me. One supposedly positive result of Evicor's time in the business is that doctors are recommending and submitting approval applications for fewer procedures that Evicor views as being unnecessary or too costly. They call this the sentinel effect. Another way you can read into this is that many doctors have just sorted out what Evicor always rejects and have thus stopped recommending it to clients. Neither Evicor or Carelon are without controversy, obviously. Evicor in 2018 was audited and found that it made inappropriate denials to 30 claimants because they hadn't kept their cancer guidelines up to date. An academic study in 2023 found that the guidelines Evicor used to approve imaging procedures for extreme lower back pain were insufficient, and 2 of the 5 doctors who reviewed their guidelines recommended abandoning them outright. The way the 2 companies are typically hired by insurance providers draws special concern on out-of-date terms like these, which would favor further denials. Evicor and Carelon are either hired via a flat rate by insurance companies, or in the more lucrative outcome, they split any savings they help insurance companies accrue. In their pursuit of higher savings, Carelon was ultimately made to settle a case for $13 million in 2022, when it was going by its former moniker, AIM. It was found that, among other unsavory techniques, the company had limited its fax machine to receive just 5 to 10 documents per order. When a doctor would send a request that exceeded this page limit to the company, they would deny the request for failing to have enough documentation. Chapter 4. The results. The results of these overhauls are all too predictable. The 5 Allstate executive positions that were splitting a hair shy of $3 million in the 90s split close to $40 million in 2020, a full 8-hour day of Elon Musk's income the following year. Check out our series on Elon. After 2,000 San Diego homes burned down in the fire season of '03, just a few years after implementation, State Farm, Allstate, and the others refused to reimburse policyholders for the value of their homes, often coming up hundreds of thousands of dollars short. After Hurricane Katrina, State Farm tried to weasel out of payouts for many claimants, explaining water had done the damage, which wasn't covered. Only wind was covered. A former consultant estimated that the Mckinsey system transferred $94 billion from Allstate policyholders to the company's reserves from 1995 to 2018. Between them, State Farm, and the other Mckinsey clients in the insurance field, that amount ballooned to $374 billion. Almost all of this is extracted from McKinsey's mentality of maximizing profits by just offering enough to keep customers from leaving, rather than striving to make them happy. In '87, Allstate paid out 70.9 cents on each dollar they made. In 1997, it was 58.2 cents on the dollar, and by 2006, it was 47.6 cents on the dollar. On the bright side, 7 years after litigation began, Deere was paid $750,000 by Allstate. The following year, Jason Aldridge settled for a confidential amount. Thanks so much for listening. Please don't forget to like, comment, and subscribe. Love you, and oh, fuck it. God, I miss Money Mike.